Tobias, walk me through the work that you and the team, Robert Buckland over in Europe, is doing with his team over at Citi, and why you're just a little bit more cautious on US equities together.
Sure. So let's start with the discussion you guys were having before about the bond market. Bond yields have had enormous impact on how you think about cyclicals versus growth versus defensives versus growth versus value, and this has been what's really changed in the past 3 months as we see the bond yield go in. Now, again, there's been a lot of discussion around what the impact, distortion, et cetera, of the Fed has been, but keep in mind, central banks globally have been keeping suppressed rates since really 2008, and what that suggests is that they don't have confidence in kind of long-term sustainable durable growth. So as a result, risk premiums are higher, which is something people don't talk about when they talk about negative yields, for example. And it is important to valuation markets. In an environment today, and I think it's like a really critical thing to understand, in 2008, in our last recession, 30% of the S&P 500 was comprised of, in terms of market cap weight, was comprised of deep cyclicals, industrials, materials, energy. And 30% was secular growth, including IT, including media, entertainment, including digital retailing, if you want to think of it that way, and healthcare, which is growing simply because of demographics. Today, that number is like 55 versus 15% in favor of growth. So the U.S. is a heavy growth market. And if you believe bond yields are going to edge higher, then growth stocks are going to take a little bit on the chin. And that's why you'd probably want to be in more value-oriented areas, which is what Rob Buckland, our global chief equity strategist, was suggesting with his note. One last point, Jabaz Mathai, who's our brain strategist, looking at that 2% number, really pointed out very significantly that because tax collections really stepped up meaningfully in June, remember we distorted the time frame for collecting it. Instead of April 15th, it was June 16th. The Treasury was flush with cash going into July and only issued $94 billion worth of bonds. $80 billion alone was just picked up by the Fed. So you left $14 billion of new issuance for the rest of the world. That's going to have impact on that bond yield. And it's another one of those distortions that are sitting in markets today.
115.22 on a nominal 10-year yield. You guys are looking for that move back towards 2%. So, Tobias, for an international story, I understand from Robert Buckland, Japan, UK, deep value, I've got all that. From a US perspective, Tobias, can you just walk me through the sector preference right now for you and the team?
So we're a little bit mixed on that. We do like capital goods. We do like consumer discretionary, but very specifically within retail and consumer services. We're not chasing consumer durables and apparel. We're not chasing autos. We think those are probably not interesting to us. And then we like financials. We like banks. We like insurance, more neutral and diversified financials today. And those are, excuse me, those are more value cyclical oriented groups. So from that perspective, we are there. We're not totally out of growth. We're not saying run like hell, because tech, hardware, and equipment, we're still an overweight on. We do have a downgrade watch there, but we're still an overweight because we think it's part of the capital spending cycle.